Not all tax changes are loud and flashy. Some are buried deep in fine print, waiting to surprise you at filing time. The Big Beautiful Bill has a handful of these hidden gems and hidden gotchas, and today we're breaking down the ones most likely to hit your wallet.
Welcome back to Full Throttle Finance, a financial literacy podcast where we take complex financial topics and we break them down into small, relatable discussions. My name is Felicia, and I am your CEO at CleanBee Consulting.
And I'm Allie, co-host and senior bookkeeper here. Whether you're running a race program or just getting your business off the ground, we're here to help you make small shifts that drive better financial performance. All right, last week on the podcast, we broke down the 90% cap on wagering losses deductions in the Big Beautiful Bill. We walked through how it works, shared real world examples showing why even breaking even could still leave you with taxable income, and explained why professional and frequent bettors need stronger record keeping than ever.
Today we're digging into 4 key changes that are included in the Big Beautiful Bill that directly impact middle income households. We're going to look at how the bill tweaks the way that the tax brackets adjust for inflation. There is a temporary deduction for car loan interest that we're going to discuss. There's also a temporary deduction for senior citizens that we're going to talk about. And there's some boost to the child tax credit that is buried in there as well too. So we're going to break down what each change means. We're going to share real life examples, and we're going to talk about both the pros and the cons so you can see exactly where you stand on these topics.
Perfect. Exactly. Let's get started with the inflation adjustment to tax brackets. You know, every year the IRS adjusts income tax brackets for hidden inflation, so you don't get bumped into a higher tax bracket just because your paycheck went up with the cost of living. This keeps the bracket creep, which we've talked about before, paying more taxes without actually earning more purchasing power, in check. The bill changes how those inflation adjustments are calculated. Instead of adjusting every bracket evenly, the new rule adjusts certain points, specifically where the 12% bracket ends and the 22% bracket begins, and then where the 22% tax bracket ends. This starts with tax years after December 31st, 2025.
Yeah, it's kind of funny, right, that we've made some social media posts specifically about how some of these tax bracket issues, right, like they directly impact that middle class section, and it's hilarious that it's still not even being modified.
No.
In a way that's really gonna help that middle class, right?
No.
So let's pretend that inflation is something like 5% per year. And just for easy rounding and easy math, let's say the 12% tax bracket ends at $50,000. That means next year with the 5% inflation, it's going to move to about $52,500. After this change, only some bracket thresholds are going to move. Others are going to stay fixed, which means that more of your income could be spilling into higher income brackets faster because, again, just that 12 to 22%, maybe even the 24% rate, just those brackets are going to be seeing the increases now. So pros, this still protects the most common middle income bracket transitions, right? We keep that inflation indexing in place for thresholds. So even if the cost of living goes up, at least those brackets are changing with the inflation. But the cons are that this could cause more bracket creep for taxpayers over time, right? Especially in that 22% bracket. You're just going to meet the 24% bracket faster if the other brackets aren't changing in tandem with this 12 to 22 or 12 to 24% bracket increase, right? So higher income, middle class households really could be hitting that 24% bracket for portions of their income faster than they might have originally thought they would.
I'm almost wondering, do they do anything like this for the higher income earners, like the 160,000 plus? Is it just for the middle class? Because I feel like they're really doing too much for the middle class. You know what I mean?
Well, and the tax brackets all used to increase with inflation. So every bracket would get adjusted for inflation before. So even your 300,000 or your 200,000, like everybody was seeing an inflation adjustment,
Mm-hmm.
but now that's stopping for the higher income classes and for the lower ones too, like that 10% bracket at the beginning, like that one doesn't, the way I read the big beautiful bill, it doesn't sound like the 10% bracket is going to see an
Inflation.
inflation adjustment. But that's specifically like I agree, like I think that like it's something with maybe like you want it to look good, but I don't think the actions are necessarily good, right? Because I think everybody should be adjusting for inflation. It shouldn't just be this tax bracket that literally sees a 10% jump from 12% to 22% when you cross over that 48,000. So
Yeah.
long answer to your question, but yeah, I was like all the brackets used to increase with inflation and adjust for inflation, but now it's just this weird 10 to 22 and 22 to 24%. Those brackets are the only ones that are going to see the inflation adjustment. No,
Inflation.
I love it. I can't.
All right. So let's talk about the no tax on car loan interest, section 70203. This new deduction will be effective for tax years 2025 through 2028. It's going to allow individuals to deduct interest paid on loans used to purchase qualified vehicles. Maximum annual deduction is $10,000, and the deduction phases out for taxpayers with a modified adjusted gross income over $100,000. The deduction can be used by both itemizing and non-itemizing taxpayers, and the VIN of the vehicle must be on the tax years where the deduction is claimed.
It actually should be on the tax return for the years.
Yeah, on
I
the
missed some words there. Yeah, because the VIN will have to be on the tax return when you file the deduction claim, because they'll have to be able to verify the VIN to make sure that the VIN meets the qualified vehicle standard.
fair. Yeah.
So I like this one. I think it has good intentions. I think it's poorly executed,
I
right?
completely
Because
agree.
I think it's great. I guess let's start about with what a qualified purchase looks like, right? So there's two parts, qualified interest and qualified vehicle. So the qualified interest must be paid on a loan, not a lease. That's a very big part of it, right? It has to be on a loan that started after December 31st of 2024. So even if the car that you have right now, if it's a brand new car, if you bought it before December 31st, 2024, you won't be able to take advantage of this deduction, unfortunately. So you have to have bought the vehicle starting January 1st, 2025, or more recent, right? It has to be used to purchase a new vehicle. It cannot be used to purchase a used vehicle. So you have to be the first and sole owner of this vehicle, and it has to be purchased after December 31st, 2024. It has to be a personal use vehicle. It cannot be a business or a commercial use vehicle. It has to be a personal vehicle that you're purchasing. And the loan does need to be secured with a lien attached to the vehicle, attached to the VIN number. So that is what dictates what the qualified interest is going to look like. The vehicle, a qualified vehicle, can be a car, it can be a van, an SUV, a truck, or even a motorcycle. It's got to have a gross vehicle weight of under 14,000 pounds. And the final assembly for the vehicle has to have happened in the United States, which that can be verified a couple of different ways. You can check the information label on the vehicle at the dealership itself, or you can use the VIN and use resources like the National Highway Traffic Safety Administration, their VIN decoder, and you'll be able to find the information to see if it's a qualified vehicle or not.
I think it's just hard because the prices of cars have gone up so much over the last couple years. Like you and I were just talking
I
about
know.
us buying our cars
I know.
just a couple of years ago, and
The different.
I have gotten so many offers from Toyota. They want to buy my used car and sell it for more than what I bought it for. And it's got like 60,000 miles on it, and it's just like this is such a great deal.
Hey, maybe you should buy a new car.
Yeah. But the pros actually are that you can claim up to $10,000 worth of interest on a new personal use vehicle, even if you claim the standard deduction. You don't have to itemize, which is awesome.
You know,
This encourages domestic vehicle purchases and stimulates our economy, which is another great thing. And it's accessible through traditional auto loans and applies to a wide range of vehicles, which is, again, very nice. But the
yeah.
cons are that there's strict eligibility criteria. You know, it can't be. There's been a lot of people I've seen that are leasing their cars lately, and you can't do that. It has to be on a loan, and it cannot be on a used vehicle either. So the income, another con is that the income-based phase-out starts at 100K, which limits the access for a lot of middle-income earners who are arguably probably a big portion of the buying market for new vehicles in today's economy.
Right.
So,
And that's what I say. Like, I think it's good intentions, poorly executed, right? Because like,
agree.
I don't know. I know what my friends tell me that their car payments are. I know what our car payment is. I know when they bought their cars. I know when we bought our car. And like, the math just ain't mathing that somebody who makes under $100,000 really would be able to realistically afford purchasing a brand new vehicle in this market, especially when you look at like no tax on tips and no tax on overtime and some of these other deductions that went into play with the big beautiful bill. I'm surprised to see that this has an income phase out starting at 100,000 and not something like 150,000 at the very
Matching the
least
other ones, at
to
least.
match some of the other bills, right?
Literally.
So it's here to stay for a little bit. We'll see how it works out. But I mean, you could easily buy a motorcycle though for
Maybe it'll make more people want to buy motorcycles.
yeah, I mean, like maybe this is just like to stimulate like the economy in terms of buying fun purchases and not buying smart, educated decisions.
I love that.
It's exactly what we need to do in today's economy.
Dude, it actually does make me want to buy a motorcycle. I was thinking I've been wanting to buy that Honda Fury for a minute, and like, yeah, I mean, honestly, it would be. It's only a $5,000. It's only, or no, it's a $5,000 or $10,000 motorcycle, brand new, and then you get to deduct $10,000 worth of interest. I mean,
per year for multiple years, like essentially for the length of the loan.
Yeah, so
right?
if you get a 5-year loan on it or whatever you're going to get on it, you could deduct quite a bit of interest.
Yeah, no, I mean, I would say this is almost designed for like small vehicle purchases, right? Like, 'cause like you can't buy a car and get a car without like a giant car payment, but like motorcycle payments are like what motorcycle payments today are like what car payments used to be.
So true.
In my opinion, right? And so like, you get yourself into like a $300, $400 bike payment for even like a super expensive like Harley or like a BMW or something like that, something like in that $30,000-$40,000 range. That's more relatable, I feel like, than like somebody who's going to even go out and buy a Prius or buy a Tesla or buy a Volvo or anything, right? Like, so it's interesting. I didn't see anything that said that it was good for like side-by-sides or like ATVs. So I think it does have to be like a vehicle that's registered for use on public roads.
Yeah.
So I think like probably motorcycles and scooters that are street legal are probably like the biggest of the toys that you can buy and utilize this deduction. But again, like this interest is a deduction that directly brings down what your taxable income is. So this is where strategy comes into play.
Moving on to the senior only personal deductions. I want to give a little backstory here so everyone understands why this matters. So before 2018, every taxpayer could claim a personal exemption for themselves, their spouse, each dependent, about $4,000 per person back in 2017. This was in addition to the standard deduction. But when the 2017 Tax Cuts and Job Act took effect, those personal exemptions were suspended for 2018 through 2025. So the trade-off was a bigger standard deduction and an expanded child tax credit, but it meant seniors, empty nesters, and households without kids lost that extra deduction entirely.
Yeah, I think there was a push to have kids, right? And that's kind of why they took that. They reformed what the deduction looked like.
Yeah.
Was because the birth rate was declining and they wanted to try and bring the birth rate up. But instead of bringing the personal exemptions back for everyone, the big beautiful bill creates a new targeted deduction that is just specific to seniors starting in 2025, and I'm so for this. So how it works is that there's a $6,000 amount per qualifying taxpayer that is ages 65 or older. So technically, a married couple where both of the spouses are 65 years or older could potentially get $12,000 off of their taxable income if they claim this deduction. You have to be 65 by the end of the tax year in which you are filing your taxes for, and you have to have a valid Social Security number. And it does start to phase out once your modified adjusted gross income goes above 75,000 for single filers or $150,000 for people who are married and filing jointly. And the phase out rate is 6% of the amount over the limit. So if you're single and you make about $85,000 and you're $10,000 over the limit, 6% of that is $600. So your $6,000 deduction allowance becomes $5,400 because you make $10,000 over the modified adjusted gross income amount. And so the best part is that this is in addition to your standard deduction. So for a single individual in 2025, what that looks like is that they're able to take the new standard deduction of $15,750. It was $15,000, but the big beautiful bill increased that to $15,750 plus the new senior bonus of $6,000. So in total, your standard deduction becomes $21,750 for a single individual who is age 65 or older.
You know what's crazy? I'm looking at like my parents and
That's exactly what I did.
Like they're both over 65. And so they get 30,000 worth of deductions just in a standard deduction. Plus they're going to get the $12,000 in this new senior deduction. Like that's crazy.
Yep.
Huge difference in their tax return. That's
Yep.
awesome.
And I don't know in that industry if he's applicable to overtime or not, but if he was an hourly employee that followed FLSA labor laws or employed by an employer that did that, right, then he could also potentially take advantage of the overtime deduction.
I'm saying
both him and your mom, you know?
Yeah.
And that's exactly what I did too, is that I looked at like what the people who are closest to me, like what their parents' ages were and like kind of what I know about their income situations and whatnot. I'm like, that could be really big. Like if my mom was still around like that, she would definitely qualify for this and whatnot, you know? So I like this. This is designed to help the people that need the help in our economy, right? They're the ones that are phasing out of being full-time workers, right? They should be eligible to get some extra additional support.
I completely agree. So here's the thing though, this is temporary. It's only available through 2025 through 2028. But for seniors in that middle income range, it's a big win. And I think this is like we've talked about in previous episodes, like this is the time to be really smart with your money and with your tax returns. And this is where you can actually save a lot of money. So, and take advantage of these temporary deductions. So,
yep.
The pros for this one is it is extra relief for the seniors or fixed income earners. It stacks with other deductions that you already get. Like we talked about the standard deduction, overtime, stuff like that. The cons are that it's just temporary, you know, disappears after 2028. And the higher income seniors will see it phase out quicker. So,
yeah, I guess another con too is, again, this is not one with built-in funding, just like no tax on tips.
Yeah.
No tax on overtime. So there's not really built-in funding. So in essence, this would continue to drive up the national debt.
Yeah. All right. So the last thing we're going to talk about today is the child tax credit. And since 2018, the child tax credit has been $2,000 per child under the age of 17, with up to $1,400 of that refundable. So those rules were set to expire in 2025, but the Big Beautiful Bill keeps the expanded version going and is giving it a boost.
Yeah, and what the difference there is that the credit would be a credit towards a tax bill or tax liabilities that you owe. And so if you owed money, you could reduce the amount you owed by $2,000. But if you manage your taxes well throughout the year and you don't have a tax bill owed, but you get this tax credit, the most that they will would have refunded you physically with cash was $1,400 instead of the $2,000 credit that you were entitled to. So that's what the difference in those two numbers is like if you owe a tax liability, you got a larger credit to pay down that tax liability. But if you didn't have a tax liability, but you took advantage of this credit, they would max pay you out of pocket $1,400 instead of giving you that full $2,000 credit. So starting in 2025, the credit goes from $2,000 to $2,200 per child. And starting in 2026, it's automatically going to start adjusting each year for inflation, rounded to the nearest $100. And so that refundable portion will grow with inflation. So lower income families can get more of the credit back each year as they have children that are under the age limit. And so the expansion becomes permanent. There's no sunset in 2025, which I think is nice for parents, right? Especially if you are a parent that's able to start taking advantage of this credit when your child is like 1, 2, 3, 4 years old, right? Yeah. Now you'll be able to take advantage of it all the way up until they're 17. So like, let's look at 2024 rules in comparison to 2025 rules. So 2024, if you had 2 kids and it was $2,000 per kid, you had a $4,000 total child tax care credit. The refundable portion of that was $2,800. So if you owed little to no tax, you would have physically gotten refunded $2,800 for those 2 kids. In 2025, what that looks like is you have $2,200 per kid times 2 kids. So that's $4,400 worth of a credit, up $400. The refundable portion will likely be around $3,000 after you take into consideration the inflation indexing. And so, that's $200 plus difference in just 1 year. It's not going to expire anymore, and it's going to continue to increase in future years because of the legislature that was passed inside the big, beautiful bill.
The income phase outs aren't changing. It's $200,000 for single filers and $400,000 for married couples, and it still only applies to kids under the age of 17. So the pros that we think for this one are more money per child each year without having to wait for Congress to act, and bigger refundable portions to help lower income families directly. The cons, no expansion for older dependents or college age kids, and the phase outs still cut out higher income families out of the benefit, which, I mean, realistically, a $200,000 to $400,000 phase out is pretty freaking high, if I do say so myself. Like,
yeah, I was literally just thinking, so a family of 4, right? Seems like the perfect candidates for a new minivan, in my opinion, but they probably would phase out completely if they made close to 200,000 or close to 400,000. Like, they would phase out completely on the income credit or the tax deduction credit on the interest for the car loan. So it's like, again, that's why I think that one was half baked. Like, this seems like, hey, we want to encourage people to have kids. We also want to encourage people to buy new vehicles. Like, it feels like that limit should be higher.
It's like the phase out should be more consistent across the board. Like, the phase out should be like $150K for like everybody, like that's where the phase out starts. But I'm
sure the government has done some sort of analysis, let's hope, as to how they've landed at whatever their threshold limits are that they are. But honestly, it's probably a little bit strategic to make it seem like people will be able to take advantage of certain things when they really probably won't benefit from it that much because, hey, it's the government, right? Anyways, so there you have it. There you have it. 4 big changes in the big, beautiful bill that could shape what your 2025 tax return and beyond might look like. We've got a tweak to how your tax brackets move with inflation, a temporary deduction for the new vehicle loans, a temporary but meaningful deduction made just for our seniors, and a boost to the child tax credit that finally grows automatically each year. When we were putting all of this information together, right, like the one thing that just kept spinning in my mind was could you imagine a mega scenario for maybe a single person with 1 kid that maybe works an industry job, let's say a bartender in somewhere high earning and high tipping like California, right? Like maybe they're making something in that $70,000 to $90,000 range. And maybe they need a new car or they're buying a new car, right? Like they could potentially see like up to $25,000 worth of tip deductions, $12,500 worth of overtime deductions, $10,000 worth of interest deductions on their car, and $2,200 worth of child care or child tax credit deductions. So like almost $50,000 worth of deductions before the standard deduction even comes into play. And all of these deductions can be taken simultaneously.
It would be
Like that's
huge.
mega.
It'd be
That's
huge.
mega, right? So if you found this breakdown helpful, then we would absolutely love it if you gave us a like, if you subscribed to one of our social media platforms, if you shared it with somebody else who could benefit from hearing some of these new deductions and how they actually work in real life for real people. We'll keep unpacking this legislation piece by piece so that you can plan ahead and make the most out of your tax situation. Thanks for tuning in, and we'll see you next Friday.
Bye.